Hello and welcome to another exciting session on standard costing and variance analysis. Whether you're studying or you're in business, you're involved in manufacturing, definitely this session will be for you. So, after going through this session, you are expected to have obtained an understanding on the following. Understand standard costing without using formulas, understand standard costing, price and quantity variances, understand material price and usage variances when inventory is held at actual cost, as well as understand material price and usage variances when inventory is held at standard cost. So, standard costing is defined as the practice of estimating the expenditure of the production process, whereas variance analysis is the process of assessing the differences between actual performance and expected performance. So, we basically have two main variances, which are those resulting from differences in price or rate and those resulting from differences in quantities. So, the focus should be on what was done versus what should have been done. So, when we look at those two broad categories, which are price and quantity variances, price variances, the variance is in the price or rate. So, we hold the actual quantity constant and we assess the difference in the actual price versus the standard rate or price. Whilst quantity variances are the variance itself is in the quantity, so we hold the standard price constant and assess the difference in the actual quantity versus the standard quantity. So now, with regards to material price and usage variances, when inventory is held at actual cost. So for the material price variance, there is no price variance when the items are bought from the supplier. The price variance only arises when the material is allocated to production. The variance follows the actual units allocated, not the units purchased. So material is allocated to production at standard cost always. So there now, as you allocate your material to production, that's when your price variance will arise based on those units allocated. So now, with regards to material quantity or usage variance, the variance is between material actually used and what was supposed to be used. So we hold standard cost constant and we assess the difference between what was actually used and what was supposed to be used. So let's apply this to a question here and we determine the variances and we also look at the journals. So Checkers Limited makes cereal and requires 200 kilos of wheat at $4.50 per kilo for the budgeted production of 100 units of cereal. During June, 220 kgs of wheat were bought for $4.80 a kg and 210 kilos were issued to production and 95 units were made. So now calculate the material price variance and the material usage variance. So with regards to our material price variance, On our price variance, we hold the actual quantity issued to production, we hold it constant. Then the difference that we are looking at is the actual price versus the standard price. So our actual cost versus our standard cost. So from there, the difference is of 30 cents there per kilo times the 210 would then give us an unfavorable $63 there. So if you see there, we are using 210, which is the issued, not what was purchased. Because at purchase, there is no price variance, but price variance arises when we issue to production. So when it comes to material usage variance, we compare what we have actually issued to production, the 210, versus what we should have issued to production to produce those 95 units. So here, our standard cost card was based on 200 kilos divided by 100 units, meaning that each unit was supposed to require 2 kgs of material. So meaning that if we're going to produce 95 units, we are supposed to use 95 times 2 there. All right, so we're supposed to use 190 kilos, but we have used 210. So it's unfavorable. We have used more material than what we expected. So now with regards to our journals, at the point of acquisition of the material, there is no price variance because we are going to be recording at actual cost. So we take what you are buying, the 220 kilos times the $4.80. Then we have the 1056 debiting our inventory there. And this is what we will be owing our suppliers at that point. Then when we issue to production, we will still be issuing based on the standard cost card that we have. So we are saying to produce 95 units, we allocate 2 kilos to each unit at $4.50, meaning that what we're going to allocate to production will be a cost of $855. However, because our inventory, we are recording it at actual cost. So we are recording our inventory at actual cost there, meaning that what we have actually allocated to production was 210 kilos at $4.80, which then gives us 1008. So there is a variance between what was actually done compared to what should have been done. So there are two variances there because our purchase price was higher than our expected price, as well as in terms of quantity, we are using more quantities than we expected to use. So that is the quantity variance there. Then that's our journal. Now we go to material price and usage variance when inventory is held at standard cost. So for material price variance, the price variance occurs at date of purchase of the material from the suppliers, and the variance is on the price, and we hold the actual quantity purchased constant. So you will notice that because we'll be recording at standard cost, but when we buy from our suppliers, we are buying at an actual price, right? An actual cost there. So there will be a difference definitely between what we will be expected to pay and what we thought we would pay and what we are actually paying. Then, with regards to material quantity usage variance, the variance is in the quantity issued to production versus the quantity that should have been issued given the output. So we hold our standard price of material constant, then we assess the difference between what you have issued and what we're supposed to issue to production. So we're also going to apply the principles here to our scenario, the same as before. And we want to look at calculating the material price variance as well as the material usage variance and the journals thereof. So considering that we are going to be recording at standard cost our inventory at we're holding our inventories at standard cost, it then means that when we purchase this material from our suppliers, immediately we are going to have a price variance there, because the 220 kilograms that we are buying, we are going to buy them at $4.80, but we are recording them at $4.50. So there will be a price variance there because our standard cost is different to our actual cost there on these units of 220 units. So there will be a $66 unfavorable based on the actual units purchased. So that's different from when we are holding inventory at actual cost, because the material price variance for when you are holding it at actual cost, we use the units, we use the kilograms or material quantities issued to production, but here we use material quantities actually purchased. So now, with regards to our material quantity variance, we are now going to compare what we have issued to production compared to what we were supposed to have issued to production. So we've issued 210 kilograms, yet considering that you are producing 95 units, we're supposed to issue 2 kilograms for each of those units there. So meaning that there will be a difference. So we are issuing more 210 compared to the 190 there that you have issued, 190 that we're supposed to issue to production. So there will be a difference there of in excess of 20 kilograms that we issue to production. So there, if we multiply that by the standard cost, it's an unfavorable $90 there. So with regards to our unfavorable, both unfavorable material price variances and our material quantity variance, we can be able to show this in our journals, where we show our journal at the acquisition date of the material as well as the journals when we issue to production. So when we purchase the material, considering that we are going to record in our books at standard cost of $4.50, we are going to end up having a price variance immediately there. So the 220 units times the $4.80, which was our actual price that we are expected to pay by our payables, we are going to have a difference of $66, considering that we are recording at a standard cost of 450 times 220, which is a 990. So the difference there is our price variance. Then, when we issue to production, we are only going to be having a quantity variance there, because work in progress is always issued at standard cost, and we always use what we have actually produced in terms of units to say we are producing 95 units and we expect each unit there that is going to absorb 2 kilograms of material at a standard cost of $4.50. So meaning that will be allocating a cost of 855 to production. However, our inventories, we have actually used 210 kilograms at $4.50, which gives us $945. So with regards to that, there is a difference there because what we have used compared to what we should have used, we we overused by a cost wise of $90 there because we used more material than what we expected to use. So that was our material price and usage variance when inventory is held at standard cost. I hope this session was helpful for you, and kindly leave questions and comments, and kindly subscribe to get notifications on new content. Thank you and enjoy the rest of your day.